Guys, welcome to Bulls, Bear and Banter. Not as tough as we started off, at least in trade. I'll ignore global cues because we are, I think, very, very, delinked from how the global setup actually looks. Even though it increasingly is looking better, but for some reason our markets are behaving differently, and but slight bit of recovery from the lows on both the large cap as well as the smaller end or the broader markets, and yeah, I mean, we'll address a few big questions outside of the fact that we'll take all of your questions as well. We'll try and address questions like, should you sell at this point?
No.
Short and clear answer.
And we'll try and justify that no as well, or yes as well.
No, but clearly, I mean, so see, nobody can time the bottom, right? You and I don't know whether this is the bottom. But the simple point being that all the time you've been waiting for a correction in the small caps at the broader end of the spectrum, it has come in. The time to sell was 20% higher. This is not the time to sell, I believe. You may want to defer your buying. You may want to stagger out your buying. All of that is completely wise decision because nobody knows.
Someone is not sitting on cash, Niraj, and there are lots of people doing that. People don't have the money anymore.
Okay, so fine. So you don't have the money. Now, if you, there is a wonderful hack, by the way. The wonderful hack is this, that if you're sitting on, let's say 10 stocks in your portfolio, and there are 4 stocks which are down about 20-25%, let's say, right? And you had bought that stock in FOMO. Okay, bahut bhag raha tha, I couldn't buy it, etc. and stuff like that. Now you're seeing a stock that you always wanted to buy with promising earnings growth also down 25%. The hack is that you're not telling yourself that you're booking a 25% loss. You are buying something which is also down 25% and swapping out from what you have into something that you always wanted to but could not buy.
Okay.
As long as you know the company well.
Right.
The added advantage of this is you book short-term capital loss, which helps you, right? So that is one. But so that is if you don't have money. But the presumption that if we are addressing the question to people who are always thinking that should I buy right now, then the answer is that this is the time to, if anything, put some measured money to work in a staggered fashion, not the time to sell. Now, yes, one large fund manager in his wisdom has said, and we've now spoken about this 3 days on a trot, but I think everybody that we're speaking to is saying the same thing, that this may not necessarily be the time to sell at least. I think one last point, Ravi Dharamshi made this I think I made this point in the morning, that the takeaway from S. Naren's conversation is not about whether you buy in or whether you sell mid caps or small caps, but that you should know what you are doing on your small cap fund.
Correct.
When you're putting a money in a small cap fund, you should know what the trade of the fund manager is and what the average multiple of your fund is. So that is one. And Ravi Dharamshi made this point right now, that I think another takeaway from S. Naren's comment is that Naren knows that people are not investing for 20 years. So if you're investing for 10 years or 20 years, sure, invest right now also. Even if your returns come with a bit of a delay, 10 years out, it's fine, because you need to invest at least 7-8 years in a small cap fund. But log kar nahi rahe, isliye wo bol rahe hai ki don't invest. But otherwise, if he was told that people are willing to put in money with a 15-year view, I'm sure S. Naren will also say, then you put in money in a staggered fashion.
But are people doing that? And therefore, what we want to tell our viewers is that don't deviate from the long-term journey of compounding. Stay with it if that's the goal, and let these small dips actually just add more wind to your to that SIP, rather than discourage you from actually putting good money to work. But at the same time, would you Sorry, do you want to come?
But that has happened,
please.
right? We've seen the SIP inflows and outflows today, and people have continued to, invest
this is
in
1
SIP.
month back.
This is Jan, of course, but
So you'll have to
Jan
wait
was
a
also
while.
pretty bad. I mean, I know February
That's true,
is
actually.
worse, But Jan was also pretty bad.
No,
and
actually, Mahima, you're right.
Yeah.
Because Feb is worse because it's happened in 4 days.
4
in
days,
Jan, it
correct.
happened over a period.
Over a
But it
period
was
of
bad.
time. It was bad, but people have still continued to, maintain their SIPs. I mean, our viewers are pretty, all our viewers, and in fact, everybody is intelligent enough to understand that, this is from a shorter term perspective, and that compounding should not be, affected just because markets are taking a hit from a shorter term perspective, comparatively shorter term perspective, and hopefully a shorter term perspective.
Yeah,
So,
and we'll keep talking fundamentals. So start sending in queries as
Yeah.
well, so therefore we get to start addressing some of those. So that's one bucket of people, and it's a great solution which Niraj gave, right? So if you're down 2 stocks, one you had bought in FOMO and one you had really bought because you know the company, understand it, reasonable valuations, and the like, and both are down 25, you can easily swap the stock where you're feeling, or you had bought it with the feeling of FOMO for the stock which you know well.
Or if you don't have it in your portfolio, but that stock is down 25%.
Correct.
Yeah.
You always wanted to buy, but you couldn't.
Correct. A couple of stocks that really stood out in this cycle, or rather, if I can call it a cycle, because it's been 33 trading sessions, but it's been such a difficult period, is something like a Bajaj Finance. And we were speaking about it during lunch yesterday as well, that there were people who thought that at 5.5 times price to book was already very expensive. Now people at 7 times price to book are saying that, hey, it's a great time to buy a Bajaj Finance because of a 25 basis point cut in the repo, and that's the funny part of it. But financials is one pocket where I think there's a consensus that valuations seem reasonable. What are the other pockets that one needs to look out for, and how should one deploy? Say you have 20, if you're sitting on, say a Parag Parikh is sitting on 20% cash, how would he, in your view, deploy? How would a Rajiv Thakkar deploy money?
Oh, very difficult to pick. He's another level. But I made some notes today, of what the numbers, etc. are like. So let's assume we do 1050 EPS in FY25. Let's assume we go to 12%. The consensus right now is 15-16%. The bear view is 9%. My beach ka 12% le raha, right? 12% growth is 1180 FY26. 1300 FY27. You're trading at 18 times. So Nifty is set. Large caps, not a problem, right? Now, where do you turn around? So on ground, if October, November, then December had this large capex point that we make about, I'm guessing January would also have had, and then the targets for Feb and March are very high. Naturally, cement comes into play, right? So, and cement numbers have been very bad thus far. Companies have come in and said, I remember Mr. Bangur coming and saying that he can't operate at this margins perennially, so it has to go. So, if that were to be the case, then select companies, especially that large capex happening in Andhra Pradesh, for example, so that geography companies, etc. So cement demand is turning constructive on the ground. Pricing may pick up, volumes may pick up.
Very interesting.
So therefore, that is one clear bucket out there where both valuations are in your favor, and maybe demand will also be in your favor.
Okay.
So that seems to be this thing, and then you of course try and figure out what sector or what companies within that you want to do. Right?
I'm just going to piggyback on that point. So basically, what the government is going to try to do, and I'm just hypothesizing here, what the government is going to try to do is they're going to try to push out capex in a strong fashion in the next 6 months, because they are seeing a visible slowdown. Sentiment is weakening. You've already given tax benefits to individuals. On top of it, you've already given a 25 basis point rate cut as well. Despite that, there's weakening sentiment. If that continues, next 6 months, they will really aim and gun to push out as much capex as possible. Give as much confidence to corporate India to do capex as possible.
Yeah.
And therefore, in the next 6 months, you might well see a turnaround in infra companies, because you will see strong order wins, you will see bunched up orders, and you might well see cement as a play, therefore do well as an ancillary as well.
Right.
happens?
So then, to follow up to that, if cement is also going up, then eventually even paints will have to, see that cycle, a reversal in that
You
cycle
gauged
then
that in
going forward.
Conversations today we speak to Berger.
Berger did say, in his commentary as well that near-term sequential uptick in demand is what they are expecting. But this is Berger, which is second largest player. But Asian Paints has still said that demand, according to them, demand will still be under pressure in the next 2 to 3 quarters. So maybe 4 quarters
And
down the line,
whose
that
commentary
reversal.
typically would you be more comfortable
With Asian Paints, because 70%, over 70% market share is what Asian Paints still garners, even today. So, but yeah, we'll have to wait and watch out
But is
for
it
paint
select
sector. But
geographies?
valuations still are not attractive,
Not attractive.
despite the kind of fall that all of these stocks have seen.
And that's where the
valuations are still
problem
not
is,
attractive.
Niraj.
I have a question to
Where
the
do
two
you
of you.
play this, yaar?
I have a
40
question to
times
two of you.
earnings,
No,
even
leave
now.
paints out. Okay,
No,
leave-
not paints. I'm saying.
So I have a question
Smith.
for both of you. Think of it this way, small and mid caps or whatever, slightly large caps, right, if you will. 12,000 rupees per month. And by the way, we'll start taking queries. So just one last point here, because we're talking sectors. 12,000 rupees per month right now. New wage bill coming up, I think, in FY27, if I'm not wrong. And then some pay commission revisions coming in the subsequent year, or vice versa. So 3 years wherein there is some bit of wage increases likely to happen. Consumer discretionary has had a really tough time the last 12 months, right?
Yes.
Valuations are not stratospheric. Because of all of this and because of the propensity to spend on discretionary, could consumer discretionary make a comeback over the next 3 years? Could we see multiples expand from where they are right now, 20, 30, 35 times to maybe 50, 60 times, coupled with earnings growth?
50, 60 times is a bit difficult, but
The companies
discretionary.
have traded. Air conditioning companies have traded those
Yeah,
valuations.
but discretionary definitely will pick up. I'm not sure about the 60 times multiple for sure.
So,
but
thoda expansion or thoda earnings growth?
Yes, definitely, because we've seen the rate cut plus the budget consumption
too.
boost. That too, we'll start seeing that from the first quarter of FY26, because that's when all of this all of the the boost and everything comes into picture and actually gets implemented. So first quarter FY26 is when we start seeing this. So 3 years down the line, definitely, and this should definitely boost the urban consumption, which has been under pressure in the past 3 quarters. So urban consumption, if that goes up, rural is already picking up. So definitely, yes, consumer discretionary should go up.
Consumer discretionary with reasonable valuation.
Okay.
I would play it through this, but I also feel that there is. So you've pointed out a few positives. I also want to caution a few negatives. Employment data doesn't look great. There is definite pain where consumer is concerned. There's less consumer confidence. Savings, savings rate in India may be high, but at the same time, the cumulative savings in the country has gone down. Post-COVID, we're probably at the most difficult and precarious position in where that is concerned, and therefore a few things to be cautious about as well, because it's not all hunky-dory. And maybe a decent play on that could also be savings-related, sectors or categories. Something like your AMCs and your asset managers, of course, but even your distributors,
Right.
something like a Nuvama, etc., could well benefit.
Somebody's asking about AMCs.
AMCs, yeah. So the question is, any view on AMC sector and pecking order among the listed AMC stocks?
So I don't have a pecking order right off the back of my head, but for sure I think that out of the 2 pockets that will benefit the most from everything that's happening in terms of taxation as well as in terms of wages related, I believe that AMCs will disproportionately benefit in that sense. But also remember that this is a cyclical play. Things could very well turn if you wouldn't see returns for 6 months, and investor sentiment, if it starts getting depressed, you might well see a bit of drag in terms of numbers. But for now, the numbers seem to be holding up very well, including the SIP number which has come today. And even the numbers which it's something like an HDFC AMC or UTI AMC declared this time around were quite strong, I mean, in that sense. So as of now, the numbers look quite healthy. But I mean, it's cyclical, and therefore don't forget that. In all of this,
I'm hopeful that this habit building that has happened over the last 4 years won't get chuffed out in a matter of 1 month.
Which is
February.
Stick to SIPs.
Stick to SIPs. Yeah.
Right.
That's all.
I think pharma sector also is one sector which I don't know about the valuations, you might know better, but I think it's underplayed because Lupin, AstraZeneca, such good numbers, right, today, but because of the entire market sentiment, the stocks are not, gaining as much as they should have considering the kind of earnings that they've posted, but valuations, you'll have a better picture.
Yeah, so healthcare, if I expand that bucket, healthcare by and large seems very attractively poised. We've seen a couple of upgrades come in for Apollo as well. The CDMO companies, we've been harping about it, or how strong the commentary was from nearly all of them. And somebody's asked this question on chemicals, so that becomes an offshoot as well, right? I think similarly for chemical companies, I think, so while Deepak and Vinati, etc. have fallen, look at Gujarat Fluorochem. In the last, whatever the corrective move, it stood rock solid because there are companies who are now saying that we are at the maybe in turning around phase. There's a company called Yasho Industries which put out its presentation and they have said that we are hopeful of some pricing upticks coming up in the next couple of months, not like couple of years. So I think select pharma, select chemicals.
Even Gujarat Alkalis, I believe, has posted very good numbers.
I was speaking about it in the morning, Mahima.
Yeah.
This is the 4th quarter wherein Gujarat Alkalis has consistently reduced its losses, posted EBITDA positives, and reduced the net loss. So 4 quarters in a row that they have done this. Clockwork. So some companies are certainly doing it well.
But so we've spoken about CDMO and the opportunity there, and we've seen those stocks run up as well. In your experience, unfortunately, my forte is not chemicals, but if at all you can wager a guess, what would be the next set of companies, stocks, products that would start to turn around in your view?
No, I think so.
Because if you're looking at some companies like an alkylamines, it's fallen from, I think, 5,000 levels to 7. This deep pain. 60-70%
quite a bit as well.
Yes.
A lot of them.
Yes.
Now it's very this is the one like pharmaceuticals, one of the most heterogeneous sectors. You can't paint it with even a whiff of a common brush, simply because everybody's got a different chemical and chemistry to itself to help itself, right?
Correct.
And all of them now make a claim that we have got this one specialty product or 2 specialty products. So very difficult per se to figure out. But I would suspect that if you want to do some work seriously, then just figure out which are the chemicals wherein the China capacity is not going to be an issue.
Right. So that global factors.
So that one comes into play per se. But largely from whatever little I've seen and the commentary that has come in from companies thus far, the Ami Organics of the world, which have got this CDMO division giving good commentary, Vinati Organics giving good commentary, Gujarat Fluorochem has given a very optimistic commentary about what their FY26 EBITDA could be. So some of them are just out there. Con call sun lo ya presentation pad lo. I think you'll get a sense. So that is looking interesting, that bucket. And a lot of fund managers are turning constructive chemicals, by the way. So that's also interesting.
That is interesting.
So the turnaround that we were talking about is now coming into play, hopefully.
Maybe.
Right.
And we are coming to the end of the earnings season as well. In 2 days'
Yes.
time. So Mahima, 18 companies out of 100 in your bucket, right?
Yes. None of them have probably done well this time.
And
Consumption as a whole. The commentary has not been good for staples for sure because, the pain in terms of raw material inflation continues and that's weighing down on their margins. They're taking price hikes, which is why their volumes are going down. So it's like a vicious circle which is not ending for these staples, unfortunately, which is why commentary also doesn't, paint a good picture for the next 2 or 3 odd quarters. But hopefully, the consumption boost that we are talking about should, give some, push up to these counters. But yeah, retail for sure has done, retail especially in the tier 2 and tier 3 cities has done very well this time.
So not
this
DMart,
is of course
not Trend.
Not DMart, not Trend, but your V-Mart, your V2 Retail, your Vishal Mega Mart.
It's funny
even
you say
Cantabil.
this. Trend grew at 35%. I mean,
It's only because it has always grown by over 50%, and this time since it's grown by about 36, 37 odd percent, the market is just not very happy with a 37% growth apparently.
Also the valuations.
But also the valuations are
It's
very
valuations,
high.
it's
Yeah,
expectations.
very high. Yes.
But I mean, growth per se on a standalone basis is very healthy.
Okay.
Definitely.
Very quickly, PSU banks, Hersh. We've discussed private banks and NBFCs a lot. PSU banks?
PSU banks. So when you're looking at just, and I don't want to discuss names at this point, but when you're looking at pretty much the whole bunch, you're looking at valuations largely where they were, or rather where the 5-year average is. Of course, the cycle is positive because recoveries continue to remain healthy for most of them. And credit costs also remain very, very subdued. So therefore, provisioning is very, very subdued, not reflecting on the P&L. But can you expand your ROA from where it is right now? I believe very limited scope. And therefore, you've topped in terms of most of your ROAs. So at this level, SBI doing 20% ROE, would you be happy? Well, if you are, then please go ahead and buy.
Okay. One last question that is coming before we wrap up. And the question is that, would you prefer the volatility of the Trump-era trade wars in the US market or the long-term potential of India even with currency depreciation? I must tell you, my view, since 2009, the one market which has been the unequivocal leader, Trump era, non-Trump, because there was one Trump era in that as well, is the US market. It's been the mother bull market. Everything else pales in comparison for the size, the liquidity, and the security that the US market gives. So, never mind how well India may have done in local currency terms, US has been the rank amazing performer, and that might well continue. The last 2 years, US markets have done phenomenally well, right?
True.
So, therefore, you can't argue against that market. क्या अपना टाइम आएगा for the next 3-4 years? Well, remains to be seen. Trump brings him with him volatility, but it's not that the markets do poorly, as evidenced in the last Trump era as well. There were years wherein the market did really well, the US markets in that era too. So I don't think it's an either or. Maybe if I was left to me and I do that, I mean, I invest in the US markets as well, and those returns have been very, very good. So why do either or? Do both.
I wouldn't bet, so I mean, personal view again, I wouldn't bet against the US market, but I believe that there are a lot of macro factors going, or rather not looking stable or convincing to me.
For the US market.
For the US markets. One is the fact that you have literally $9 trillion of debt, which is going to get refinanced this year, major bulk of it to happen in the first half. That's a large quantum. Even if the Fed were to cut, and they're desperate to cut, but they're unable to, because inflation isn't showing signs of a slowdown, you will have a very high interest rate burden on that refinance debt. And therefore, the scope for the US government continuing to spend at the clip at which it has been spending, I don't know for how long can it go on for. Basically, that's my hypothesis. How long can you run a 6% fiscal deficit and continue to allow your people to spend?
The thing is, the same question was asked when it was 4%.
Yes.
How long will it happen? And the
Yes,
reserve
yeah,
currency
so
of the world continues.
Hence,
to
I wouldn't bet
surprise.
against it.
Yeah.
But I'm
Yeah.
not so sure whether I would want to put.
Someday it will flip. We don't know when. But anyways, we need to wrap up. Thanks so much for tuning in. Tune in 12:30 tomorrow. Sorry we are 10